So again, don't forget that you are investing into property team investment. Investing into, let's say, residential property, it was quite active for the past 6 months property market. So everybody expecting is a recovery, and we are yet to see this recovery in the residential market. We see the prices as move up a little bit, but just the prices. Transaction remain is not that great yet. The concept of this property investment, looking at the liquid as well as flexible, if you're investing into REITs investment. As compared to your hard bricks and mortar kind of investment, you are subjected to cooling measures. Okay, you can't cash out. You also have a peace of mind of without engaging any plumbing service, roof leaking, piping issues. And other than this, you're also facing this property maintenance related issues. Okay, if you own a real property. But being Asian Singaporean, we love property. We love to own something that we can hold on to it. All right. Regular income as well, it allows you to access to about 5% per annum dividend yield. Okay, it's better than collecting rental. Bear in mind that there's no delay in the rental payment. If you buy property now, you can achieve 3%. That's very, very lucky already. But if a private condo, I think it's about 3% and below. So again, we like to stress here is that quality investment, Singapore property, Singapore REITs, is one of the best in the world, as well as the best in Asia. All right, so Singapore REITs market, you have to look at the three key components. You got to look at the quality sponsors, right? It makes REITs more resilient, more reliable, as well as better qualities. Second one is the law, regulatory framework. REITs have to declare dividends and then obligated to pay up to 90% of the earnings to the investor. So this is updated by MAS that they came out a new law last April to allow REITs operator to leverage up to 50% of their debt over asset ratio. But this being a asset manager, we are a bit reserved on that, because the more you leverage, you have to face the pressure on the leveraging cost. Financing cost will be very high, because the landowner should be very solid in terms of the cash flow, because when crisis hit, won't be able to pay back their debts, so they have a cash flow problem. Because of the cash flow problem, they have a dividends problem, so they can't pay out the dividend. Investor will have a confidence issue over this REITs operator. So it's actually a chain reactions towards these REITs operators. Okay, so dividend income, is non-taxable. The other thing is the catalyst, the prospect. Okay, as you may see, more and more Asian country are being developed. Once this city be urbanized, more and more good quality property will be injected into the REITs. Very classic example, you can see Saigon Square, owned by the Keppel Group. Capital Land also venture into that space. So these are a good example about the catalyst for the Asian REITs. As you may know, Asia is the central of growth for the next century, as well as low interest rate also. So interest rate, just to share with you, we manage money market fund, the largest in Singapore, about 1.4 billion Sing dollar. That alone, we have US dollar, about 400 million US dollar as well. Both add up about 2 billion Sing. Okay, so low interest rate has forced us to look for steady and stable. Okay, not looking for high yield volatilities asset, so that it actually diverse from your investment goal. Okay. Singapore REITs, those icons property that you are familiar with. Raffles City is where our office is. It was about 3 billion. We have Ascot, we have Marina Financial Center, Vivo City, the largest in terms of the space, about 1 million square feet, managed by Maple Tree. So these are the crown jewel assets, best among the Asia property. We have diversified assets from a different sub-industry, like data center, we have business park, we have offices. Okay. So you have to look at the yield spread when you're investing into REITs or bonds. Those give you fixed income. Yield spread is actually opportunity cost. Okay, if you put your money into the government bond, which is free, risk-free, it gives you 0.9% for Singapore paper. For the REITs, it's about, let's say, 6%. So your 6 minus 0.9, you got about yield spread of 5.2, which is very, very high. Normally, the yield spread ranging about 3.5 to 5%. So because of the low interest rate environment, REITs is actually very, very effective. As compared to the region, Hong Kong, Australia, Japan, and US. We are one of the highest. Okay, next to Australia. Why we tell you importance of dividend is because only the solid company that has a proper profit are able to pay out profit as a dividend to share with the investors. And then you can see Australia is actually basically is retiring market, but they are very solid. Dividend return consists of compared to price return. They are very high percentage in as a part of the price return. Okay, about 90% is a component. And so Singapore for this part is about half dividend return compared to component of this price return. So this portion has been going up significantly because more and more people seeking for income investment instrument. Okay. So flashback last year during the lockdown, retail was bad. Okay, retail mall, the traffic was down 60%. So three things happened in the retail sector. Why? First is the tenancy discontinue. You can see some of the retail shop closed down in the mall. So tenancy discontinue because they exhausted the rental deposit. No business, they have to close down. Cash flow mismatch. Some of the REITs operator is already happened, right? CapitaLand used to pay 4%, then they cut 2%, 3%, which means 25% down. Most of the retail operator experience that kind of a situation. So will we recover? We don't see a very strong recovery yet, but slowly. So you have to position if you are the fund manager for yourself. So cut in the dividend per unit, as you may know, SBH REITs is an example, 70% reduction in the DPU. Hospitality sector supply, some are under construction. Your good story will kicks in 2022. So office segment, office we see low a little bit because occupancy rate is still very high. It's above 90%. Although during the COVID lockdown and all this, financial sector is actually booming. Banking, we see maybe they are weakening for the next 5 years time, 10 years, due to the earning has been compressed, low interest rate environment as well. Those financial sectors, company, including ourselves, we are doing okay. Actually, we are expanding. Phillip Security also expanding, and I heard that they will take more office space in Refuge City as well. Okay, so we don't abandon the ship yet. We see the demand will be slightly softened, but because of more family offices and more regional or MNC coming into Singapore, so office space is actually very vibrant. Okay. Vacancy level, yes, slightly rising, a bit high, but not at the worry level because the occupancy rate is still above 90%. So there will be a potential stress, okay, at the co-working sectors because some of the startup, some of the fintech might not be able to withstand the cash flow, then they will close down because of the co-working space. They make up about 30-40% of the office demand. Okay, so it will create some longer lead time, waiting time. Okay, due to the expansion on whole cost containment, but not to us because we are expanding. The industrial sector we are looking at was a data center, but some of them is mixed, right? They're using a business park for some data as well. A warehouse space was highly in demand. Business park as well, because the number offered to the market is very limited since last year. So it was not hit by this COVID lockdown. We also see the demand for logistics as well as a data center has been increasing. So a business park can be used for a data center or operation center. So because it's a mixture. All in all, industrial sector has been doing very good for the past 12 months. We see they will continue to be steady. Okay. This is the dividend track record payout. In January, we pay 5.147, April 4.84. So when you look at our asset allocation, we push out the retail already. We used to hold last quarter, 3 months ago, we hold a lot of industrial compared to retail. And then we put into offices, and then we increase the hospitality as well.